and welcome to Sundaram Fasteners 3Q FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Mukesh Saraf. Thank you, and over to you, sir.
Thank you, Viren. Good morning, Mukesh here from Aventus Park. Appreciate everybody logging in. I'm pleased to be hosting the management of Sundaram Fasteners on this call. We have with us Mr. Dilip Kumar, Chief Financial Officer, Sundaram Fasteners, Mr. C. Rajagopalan, Executive Vice President Marketing, and Mr. R. Ganesh, Senior General Manager Finance. We'll start with brief opening remarks from Mr. Dilip Kumar and then follow it up with the Q&A. Over to you, sir.
Yeah, good morning. I welcome all of you to this conference call on Q3 performance. Just a customary announcement, if there are any journalists or media personnel you want to quote me, please kindly check with me, verify the facts before putting out any news item. On the results, just to read out the numbers, the standalone financials for the quarter, the revenues were at 1,180 crores as against 1,226 crores. The context to this is it is not a revenue drop as you see from the numbers, but it is because of the impact of the floods which we had in Chennai, which affected the operations for a week or so at our factories in Chennai. So, but for that, we would have probably been better than the corresponding period of last year. The domestic sales were at 812 crores compared to 813 crores of the previous year. The exports came in at 339 versus 364. So here again, apart from the disruptions in the operations partially, the strike by the United Auto Workers has ended, as we all know, and the stock buildup which was there in respect of our products is now the inventories have been consumed, and we expected to have a strong Q3, which we think now will shift to Q4, and by all indications, the month has started well for us, and we expect to finish this quarter strongly. We had started with around $200 million with an aspiration, and we said in the last call we will be somewhere between 160 to 180. I will still hold on to that number. We should finish somewhere between 160 to 180, given how we have started the first month. So that's on the exports, and as we go along, we will get into more details if you have any more questions. On the EBITDA, we have crossed 200 crores for EBITDA for the quarter, and the EBITDA expansion also has happened compared to the earlier year, where it was around 15%. Now we are inching towards 17%. There are many factors in the benign raw material prices, and the softening is there, and we've also negotiated hard with some of our suppliers. We've got a good commercial discount on the raw materials. We've also managed our stores and tools, repairs, other discretionary spend more carefully, and our fixed costs have been under control. So, which is why we have seen expansion in our margins at the contribution level as well as at the EBITDA level, because our product mix has been favorable, so subcontract operations have come down, and the power costs have been managed well because we are bringing in more and more renewable sources of power under the group captive scheme. So all of which have helped to improve the contribution and the EBITDA. Despite the increase in capital expenditure, we have been able to keep the borrowings under control. We had also paid the dividends last quarter, and our interest finance costs have been stable. And we had announced that we would be spending about 1,000 crores over a 3-year period. We are pretty much on target to spend that kind of amount. And some of you also may have noticed that we had entered into a memorandum of understanding with the Tamil Nadu government in the recently held Global Investor Summit, where we had said we would spend about 1,400 crores up to 2027-28. And these are based on clearly well-defined plans and customer orders, etc. So we have signed. That was one of the significant milestones this quarter. Our debt-equity ratio continues to be strong at 0.11. The profit before tax for the quarter came at 155 crores compared to 142 crores. The PAT was at 116 crores, over 106 crores, a 10 crore increase compared to last year. But if the operations had not been impacted, probably would have added another 10 to 12 crores more to the bottom line. The consolidated financials for each quarter was at 1,367 crores compared to 1,403 crores. The net profit was at 129 compared to 118 crores. Here again, our Chinese venture is doing very well, and though there is a bit of a slowdown in the construction sector where we are present largely in China, but the passenger vehicles and EV segments are doing well. And we have had a very good Q4 there last year. We expect that trend to continue in 2024. And they have done lots of hard work in improving the gross margin, and that is circulating down to the profits as well. And the UK venture, which had also turned around, had quite an impressive year in 2023. And though the interest rates are high, truck markets are slightly slowing down. The industry dynamics are changing a bit, but we are watchful, and we are confident that we'll be able to repeat the operating performance of CPFL in 2024 as well. So moving on to the 9-month number, the revenue from operations was 3,630 crores compared to 3,684 crores, with net profit for the 9 months at 347 compared to 347 of last year. The consolidated financials came in at 4,199 crores of revenue as against 4,214, with a profit after tax of 391 compared to 372 crores. So these are some of the financial highlights which I wanted to share with all of you. And we are happy to take any questions on the market, operations, any questions you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Participant, if you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Vimal Gohil from Alchemy Capital Management. Please go ahead.
Yeah, thank you for the opportunity, sir. So my first question would be if you just give me the mix for the 9 months for our segments, both PVs, CVs, and so on and so forth, and the product-wise mix, if possible.
This is Ganesh here. Am I audible?
Ganesh,
Is it okay?
yes.
Is it okay now?
Yes, sir. Now it's okay. Please go ahead.
With respect to the domestic market, the split between the segments would be in passenger car, we are there at about 40%. of the revenue, and with respect to HCV and LCV, along with engines put together, it will be about 35%. The tractor segment would be in the range of 10%, and 2 and 3 wheeler would be sub 5%. This is the broad domestic segment-wise sales we have experienced for the last 9 months. And with respect to the OEM, aftermarket, and export mix, if you look at OEM would be about 60%, and retail 10 to 12%, and exports sub 30%. That is a broad mix that we have experienced for the current year.
Okay. Sir, how much did you say the retail was? Aftermarket, how much? Sorry?
It will be 10 to 12% of the overall revenue.
Understood. All right. So my next question was on you explained, or rather reiterated in your comments, that there was some favorable product mix which helped in the margins. If you can just clarify exactly which products led to better margins for us, and will that continue going into the future?
Yeah, when you talk about the mix, actually, we are present from the commodity to highly value-added parts. So I think the requirements in terms of both domestic and the exports on the highly value-added parts, or the precision machine parts, are higher. Also, the near-net shape parts, what we make, that was also a higher content. And then the industry is also moving towards better finish in terms of moving from hexavalent to zinc aluminum flake and nickel chrome flake, zinc nickel finish and all that. So these kind of super finishes also has helped us to improve the and also, as Mr. Dilip mentioned, the subcontract cost, which we have been able to keep it under check, and the product mix changes, that also comes down, which helps us to improve our contribution and the margin. Primarily the value-added parts, and then the different kinds of finishes which we are bringing on board is helping us to have a better moving up in the value stream.
Understood. And sir, if you can just help us with an update on your industrial segment.
Yeah, industrial segment, we are going well. Actually, when you talk about the industry, apart from the automotive, we are penetrating deeper and wider into the entire industry, both domestic and exports, in terms of servicing the various other small OEMs, we call it. Okay, I don't want to use the word small, but OEMs of larger and then relatively lesser in terms of sizes. And that primarily we deal through the channel mechanism what we have, either through the distributor or through the direct dealers. And that is going, of course, it was not very great, it was a little subdued in the last few months. And then we hope that will also pick up. But then the penetration is there. As we speak, we continue to expand the network in terms of the dealers and distributors, and then also adding more dealers as we speak, and converting the competitors' dealers also into our fold.
Understood, sir. Thank you so much. I'll fall back in the queue.
Thank you. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Anirudh Shetty from Solidarity Advisors Private Limited. Please go ahead.
Yeah, I just had one question. With Euro 6 norms, do you think that that could have implications for our business if, say, the requirement encourages more stainless steel application versus carbon steel application for some emission norms? So I just wanted to get your thoughts around that.
Yeah, I think it's a good point what you're making. When we talk about the exhaust, definitely stainless steel, the participation is more, and Euro 6 is definitely one of the earlier question was there. That is also helping us to move in the value stream. And stainless steel, we have started couple of years back, and then we are gaining traction. And then from the standard parts, we are now moving into critical parts which are going into the exhaust applications. So that will again become a significant thing as we move along.
Got it.
Not only stainless steel, even the supervised like Inconel and then titanium and all those things, both in Euro 6 and also in the aerospace segment.
Got it. That was my only question. Thank you.
Thank you. The next question is from the line of Nemish Shah from MK Investment Managers Limited. Please go ahead.
Yeah, thanks for the opportunity. So I had a few clarifications. So this quarter we had another income of about 24 odd crores. So can you just explain what would be that pertaining to?
Yeah. So this represents in general we have sales and tools consumables which we when there's a sale of tools to the customer, this comes as an income. This will not be a steady state occurring every quarter, and whenever the customer gives an acceptance for the sale of tools, there is a spike of that income in that quarter. So normally it reflects that, and also it reflects the foreign exchange movements based on our accounting and actual realization. So these are some of the items of income. This may not get repeated every quarter.
Understood. And in our press release, so we've mentioned our EBITDA margins to be at around 16.8%. So is this excluding the flood impact, and does this include the sale of tools in your calculation?
Yeah, it includes the flood impact also.
Okay. And so just to clarify, so we've kind of accounted all the impact and the individual expense items, and then you mentioned that you've kind of taken some insurance, ad hoc insurance claims. So that will also be included in the other income?
Yeah, this is also included in the other income. The net impact is 7 crores.
Understood. Okay. Yes. Thank you.
Thank you. The next question is from the line of Pratik Bantia from Girik Capital. Please go ahead.
Yeah, hi sir, good morning. This is Dawal here. So a couple of questions. First is, what is the contribution of wind energy segment in the Q3?
Yeah, the wind energy segment, the contribution will be around, in the fastener side, that will be about 12 to 13%. I'm talking only about the fastener domain.
Fastener domain is roughly 1/3 of our revenues.
And in that 10 to 12%, yeah. And that is, okay, that's one area which is gaining traction.
Okay, so no, your voice was not very clear, sir. Can you just repeat what was the contribution?
Yeah, the contribution of wind in the total fastener pie is about 12%, 12 to 13%.
12 to 13%. Okay.
Yeah, of not the all company revenues in the fastener space.
Yeah, and fastener is 1/3 of the top line.
Yes.
Okay, so 12-13% of the 1/3.
Yes, sir.
Yes.
Okay. And sir, how is the outlook for the wind now and for the fourth quarter? We were expecting around 40 crore kind of 30-40 crore of revenue contribution for wind in the fourth quarter. Should we be around that number?
Yeah, it will be around that, because definitely it should be around that. That segment is also doing well, and there was some correction happening in the year 2023, and the general indication given by the big players in the wind energy is so the indication given is the guidance given for 24 is very good from our customers. So that will increase, and we have also added we are adding capacities, and then which will kickstart by let's say March or April. So next full year financial year benefits will accrue from the additional capacities what we are putting in place.
Correct.
So consistently also started, shipments have started going in the wind area. To one of our large customers.
Okay, on the wind side, yeah. And sir, on our EV project, things are on track as what we have been discussing?
EV project?
Yeah, with respect to the EV project, we are on track with respect to submission of samples and the validation at customer end. So hopefully, as planned, the revenue should kickstart in H2 of next year, 24-25.
Yeah, and order book stands at around 4,000 crore?
Yes. Over a period of 6 years. 6 years, correct.
And sir, again, coming on the exports, so year over year our exports have degrown. So the reason would be, one would be the flood, right? I mean, that the 6-7 days were lost due to flood.
That is not the main reason. That is partly, probably an insignificant reason. Yes, definitely, just to clarify, while we had reported a 10 crore higher profit number, it could have been another 10 crores more if we had that additional sales of about 40 to 50 crores. But that apart, all our major businesses export, and there have been various reasons. For one of the products, there has been the demand has moderated. Another product line faced the customer cancellation or slowdown because of the UAW strike, and the customer also had some supply chain issues, definite change, etc. So various factors have contributed to the lower exports for the 9-month period. And things, like I said in the part of my beginning, in the opening remarks, things are looking up. We are encouraged by what we have seen so far in Q4.
Okay. So things have changed between our last conversation post Q2, where we were expecting Q3 exports outlook better than Q2. So in the last 2 months, all these things have happened.
Yes.
Just to add, just to give a little more information, especially in the commercial vehicle segment, there are certain supply chain constraints with some of our major customers. So there are two things. One is the end customer requirement. The order book is strong for them, but then they are not able to. The productions have dropped because of certain supply chain issues. Of course, one is their domestic issues, as well as the issues in the Europe, and on top of that, this Red Sea. So all these things has also contributed in a very unfavorable manner. But inventory correction, what we expected, is happening now post that strike, and we are expecting that things will start moving upwards maybe by February end or March. So which would definitely give the benefit to us in our Q1 and their Q2.
Okay. So now, on the export front, how would you like to, guide for the FY25 outlook? How do you see export contributing to our top line?
So the exports I would traditionally contribute to 1/3 of our revenues. This time it's around 30%, pretty close to that 1/3 number. I think with the new project, EV project, coming on board, coming on stream, the second H2 of next year, we should be back to about 35 to 40% range.
35 to 40% for 25. Okay.
Yeah, for FY25.
Okay. And the problem of Europe you mentioned for the US customer, the supply chain problem. So what is that problem in Europe? Is it still that Ukraine-Russia war or some other reason?
The combination of Ukraine-Russia war, of course, even I'm talking about independent the US customers and even in the Europe customers, the projection of the truck CV segment, they have projected slightly muted for the year 24. So with some of our major customers, so we are expecting some drop in that, and also EV is not really gaining traction the way we expected. So, but it is happening. But it is happening very slowly. That's the only thing. So, on the whole, definitely this 24 would be, I would say, definitely better than 23. Despite the Red Sea and things like that, and we only hope that it gets eased out and doesn't get aggravated.
Got it. Okay, great, sir. Thank you very much. I will get back in the queue. Good luck. Yeah.
Thank you. The next question is from the line of Sahil Sanghvi from Monarch Network Capital. Please go ahead.
Good morning, sir, and thank you for the opportunity. A couple of my questions have already been answered. I just want clarification on one front. The loss of production due to the shutdowns of operations on account of the floods. That number you quantified about 40-50 crores? Am I right?
Yeah. Correct. You are correct. Your understanding is correct.
Okay. Thank you. That's all. Thank you, sir.
Yeah. That's 40 crores in terms of revenues.
Right, sir. Right. Thanks.
Okay.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Rahul Ranade from Goldman Sachs Asset Management. Please go ahead.
Hi, sir. Thanks for the opportunity. I just wanted one clarification. So, remember, during the past year, we used to have some divergence between, steel prices domestically and the one that are used in terms of pricing of exports. So, has this divergence normalized, or do we expect, further gross margin improvement on the export revenues for us?
No, with respect to the steel prices, now whether it is domestic price or the imported price, I think they have all now stabilized and they are in the same range. We are not seeing any exclusive advantage of importing or using domestic for our export business.
Okay. Our exports, if I'm not wrong, were linked to an international benchmark which was causing a difference between local and international prices reflecting in our margins last year, right?
Yeah.
That you're saying is normalized now.
So that still continues with respect to any steel material movement. Export business for specific customers are linked to AMM bundle price. So that the practice still continues.
Okay. Understood. And any, kind of impact that you are seeing from this whole Red Sea related issues in terms of our export traction? I know it's too early to ask, but yeah, anything that you're already seeing?
Yeah, the impact is twofold. One is the transit time has increased by 2 to 3 weeks. So it has to go via that Cape of Good Hope or whatever. So that is one thing. Second thing is this container shortages again as it was easing down. Last time I said it is easing down again because of this. The costs have gone up. So that is one more thing that may put pressure on the margins. One is lead time increase, the other one is the availability and the cost. So generally there is a 2 to 3 week kind of a delay is happening.
Okay. Container cost paid by us, is it? Anything incremental?
Pardon?
Container cost increase has to be borne by us. Any kind of extra kind of cost that we incur in terms of shipping.
No, the customers have been supportive so far. So it's a bit of a negotiation, but so far the need for the products and their supply chain should not get affected. So that is where it is.
Okay. And sir, how should we think of margins, let's say, over next year and year after that with, advanced automotive products kicking in? One of our peers who, kind of works exclusively in this reports fairly high EBITDA margins on that portfolio. So would it be a meaningful kicker to our margins also as the contribution ramps up?
Yeah, so our margins should be, because we are investing in an existing unit which is expanding. And you referred to our peer, and I think our margins would probably be much better than that based on the initial indications. So the margin profile will increase in our export business, and given the fact that our wind energy business is also coming on stream in the coming quarters, and the second half, the EV business is slated to pick up, and the raw material prices have been favorable so far. The confluence of all these factors should expand our margin in the coming quarters.
Understood. And lastly, just on this 4,000 crore order book over 6 years, so would this be, kind of largely back-ended? Is that the right way to think about it in terms of translation into revenues, or would it be, kind of fairly well spread over the 6-year period? How should we think about that?
Yeah, it will be well spread over a 6-year period.
Okay. Understood. Well, thanks. This is very helpful. Thank you.
Thank you. The next question is from the line of Prolin Nandu, an individual investor. Please go ahead.
Hi management. Thank you for taking my question. My first question would be, what would be the margin loss because of the flood? Because you have also included the insurance claim there. So can you help us understand what would be the margin loss?
So I would not say margin loss, and I would say if we had done about, let's say, 40 crores more, and we would have had, our PAT would have been probably higher than another 10 crores, 10 to 12 crores.
PAT would have been higher by 10 to 12 crores. Okay.
Yeah. So that is the positive thing which we think will flow into Q4. So it will be more the revenue postponement which has happened, and not the impact on any margins.
Understood, sir. Thank you for that. The second question would be, in the export markets, you said that even if we leave aside this impact of flood, there have been some supply issues at the customer end. So what I would understand is that once these supply issues get resolved, not only some of the pending orders will get executed, but the schedule for next year will also get executed. So can there be a case where next financial year onwards, that is FY25, or specifically for that, export growth can be substantially higher because of this bunching up of some of the pending orders and the usual schedule for the next year as well? Is that a fair way to look at things?
I think it's absolutely right. I think that's a fair way to look at it. But we have been jumping from one crisis to another crisis internationally. It's the Russian-Ukraine, then the Israeli-Hamas, then the United Auto Workers strike, now the Red Sea. So we've been jumping from one thing to the other in the world. So barring that, your assessment is absolutely spot on.
Great, sir. So thank you for that. And last question would be, sir, as you said that your EV project or EV order execution will start sometime in FY25, right? And that's the 4,000 crore potential over the 7-year period.
6-year period.
6-year period, I'm sorry. Can you help us understand some of the other newer avenues also that we are working on, and what is the pace with which we are working on the RFQs, and how has been our success rate in some of the recent RFQs versus the success rate in the past?
Yeah, normally, our SFL policy is not to depend on one single customer or single segment. So in the EV itself, whatever big orders we have got from one customer, we are working with other customers also. So we are working with other customers, in fact, in international as well as the domestic. So we are consistently working on all, as we speak, the RFQs, and we are trying to, some validation time in some areas could be a little longish, but that is to be expected only. So So I think to answer to you in a simple manner, the RFQ is gaining momentum, and then we are trying to increase the speed with which we react and then develop. And then that is going to be, because we are not going to be depending on one single, of course that large pie of the order is there, and then we will be adding so that the continuity is maintained during those 6 years and beyond as well.
Yeah, so strategically, this new business, the wins, have also helped us to showcase our technical prowess, our engineering strength to other customers with whom we have been in the traditional ICE business. So a lot of RFQs, discussions, technical discussions are underway, and hopefully in the next 12 months or so, some of them will translate into purchase orders.
In the ICE again, it is getting instead of dependence only on gasoline. Now we are looking at hydrogen and other alternative fuels. So with all those platforms also, we are working with them, but it's going to take a little longer time because nobody knows exactly which is going to be the winner. But definitely the ICE would coexist with the EV is what the larger prediction is. Not that the EV is going to occupy the entire ICE space.
Sure. And any new order, will it be dependent on capacity, or capacity is something which is not a constraint, and any new order which we can win, we can probably add the capacity in modular fashion in the future as well? I mean, how dependent is any new big order win on the capacity, existing capacity that we have?
Yes, typically, we add capacity after we reach, let's say, around 75% utilization. We have our start assessing capacity moment we reach about 60 to 65% of utilization. Thereafter, the capacities are closely monitored, and if there is a huge win and requires execution over a longer period, with time frames such as 6 years, if the capacity is not sufficient, we will definitely add capacity, and investment and creating additional capacity is not a constraint. And we also have a strong subcontractor ecosystem, and who are also with us for the last 60 years. So depending on the criticality of the part, we can develop it in-house or subcontracted. So I think in my assessment, capacity will not be a challenge.
Great, team. Thanks a lot for all the answers, and all the best.
Thank you, sir.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Jyoti Singh from Arihant Capital Markets Limited. Please go ahead.
Yeah, thank you for the opportunity. So, sir, my question is on the order book side, that we are targeting to execute 4,000 order in the 6 years. So how we are targeting and what are its strategy? And is there any customer where we have a larger order?
Can you repeat your question?
Yeah, so my question is on the order book side. So, what are the strategy? I mean, how we are going to execute it, on a yearly basis?
Yeah, we have a very firm indication whenever we are bagging big order. We have been saying 6 years. So we know what it is going to be in 25 or 26 and 27. So the life cycle monitoring is done, and then we also, as mentioned earlier by Dilip, we have the capacity, and when the requirements, the peaks, we will be in a position to, we will be working ahead to add the capacity. So, and also the additional programs, whenever comes, we keep monitoring, evaluating the capacities, and then wherever there is a gap, we work in advance so that, we have the capacity ahead of the demand. So this is one thing. The other thing is also just to add, there is a lot of Atmanirbhar issues related things going, where the government is insisting that they are curbing the imports, especially in fasteners and all that. So that also they are expecting inflow for the next 1 or 2 years, so that a lot of localization will happen. So, yeah, development and submission the samples in time, whenever, zero smooth takeoff, we call it, zero issues. So we work in tandem with the customer on the PPAP schedules and sample submission, and then the bulk ramping up.
Okay, thank you, sir.
Robust system we have to ensure that, and even the customers, once they start pulling in, only after we create a consignment stock at their end, wherever.
Okay, thank you, sir. And sir, another question is on the second half, Q4, how we are expecting and what are expectations from H1 FY25?
Yep.
No, I think with respect to Q4, as explained in the earlier discussion, with the supply chain settling down fairly beyond February and March, there will be a marginal uptick for the Q4, and we expect things to be better off in H1 of 24-25.
Okay, thank you, sir.
Thank you. The next question is from the line of Mukesh Saraf from Avendus Spark. Please go ahead.
Yes, sir. I just had a couple of questions. Firstly is, we've discussed a lot about the exports, but on the domestic side, could you give us some sense on how are the markets behaving, especially on the CV, tractors and PVs? Because this quarter we seem to have kind of been flat YOY. So how is the outlook ahead on the domestic side?
Well, the domestic is not really great in terms of the industry growth. What we are expecting is only around, if the weighted average could be 3 to 4%. It is mainly dragged down because of the tractor segment pulling the thing down. CV, we expected it to grow beyond 10-15%, but that is also going to be around 6-7%, and then the passenger car around the same level. So the overall industry growth would be around 3 to 4%, and then definitely our revenue would be much ahead of that.
So much ahead. This is going to be driven by some new products, or is it market share?
It is, it is both new products and the market share, and also a couple of customers where we have been aggressively pushing our sales, and then in the commercial segment, we try to work, as I said last time, wherever our business is weak, we try to penetrate more, adding more items. We have developed a lot of parts in the last couple of quarters. So I think the revenues will, those are the new parts which you mentioned. So that share of business growth, new parts, I think that will help us to go ahead of the industry segment in every segment. Whether it's tractor, whether it's CV, whether it's LCV, like that.
Right. And we also have some of your existing customers launching EVs in the domestic market, probably starting this year. So are we going to be taking part in some of those programs?
Yeah, we are already part in. In fact, if you look at significant presence of EV today in the four-wheeler is from Tata Motors. All are our parts only, Sundaram Fasteners only. Many of them are horizontally deployed from the current library, and few of them we have developed as well. And Mahindra, other customers we are developing, and then so they would be they're all launching stage. So the real revenue and significant revenues will come only as they scale up. But we are going to be there in that all of those platforms.
Okay, but that is Sorry, sir?
Yeah, all the three-wheeler and four-wheeler is our focus.
Got it. So that is not part of the 4,000 crore order book that we have. So any kind of quantification we have for this domestic EV orders?
No, Mukesh, I think with respect to the scaling up of business for EV segment in India, it will be in line with the customer pull. We are present with all the key players in the car and to a certain extent in the two and three-wheeler. So it would be dependent on customers' pull.
Okay. Got that. And secondly, we have 1,000 crore kind of a capex plan. Could you give some sense on the current capacity utilization? If I exclude this capacity that we are adding for EVs.
Yeah, we will be probably around 65 to 70% of utilization currently. And like I said in the earlier part of the call, we are assessing our capacity, and as we are getting into the business plan exercise, we will map the plan versus our capacity, and whether we need to strengthen our subcontract ecosystem or whether we need to invest in those. Those decisions will be made now, but broadly, yes, we are between 65 to 70% currently.
Okay, got that. Yeah. And maybe one last one on the PLI scheme, sir. We've been in touch with the ministry, I guess, on this side. Any kind of an update on this we have? What kind of PLI we can get, when it will start?
So, as you know, government has extended the PLI scheme by one more year, which is good for the industry. There has been a lot of interaction between the Ministry of Heavy Industry and the companies which have got approval, both OEMs and auto components. And so the products are being qualified, tested, and there has been a site visit to our plant. So all that has progressed well. And once they approve this product as AATP, Advanced Automotive Technology Product, the incentives will start flowing. But I would not, jump ahead at this stage and wait for things to roll out in the next few months. Okay, and the range could be the same 8 to 13% of revenue share? Yes. So that's the policy provision, so that has not changed. And some of our products have very high value addition because many companies have had a challenge with creating domestic value addition because under the policy you need to have a DVA of more than 50%. So ours is not a challenge from that perspective. Okay. All right, sir. I guess we are done with the questions. Okay. Maybe if you have some closing remarks before we end the call. Yeah, so as a closing remark, the outlook for Q4 looks better than Q3. We expect the export market to perform well, our exports to perform well compared to the Q3 or Q2. All the bad news is behind us. And we should see a traction in the domestic market, and we expect, and also like I mentioned, the softness in the raw material prices and the additional revenues coming from wind energy segment. So all of which should push up our revenues and expand our EBITDA and overall profit after tax. The Q4 looks, I would say, quite promising. All right, so great. Viren?
Yes, thank you. On behalf of Sundaram Fasteners, that concludes this conference. Thank you for joining us, and you may now disconnect your line.